Welcome to Monk Media YouTube channel. For most people watching the charts that day, the silver crash looked sudden, violent, almost unnatural. One moment the market was calm, the next it felt like the floor disappeared. But anyone who truly understands markets knows this is how collapses always look in hindsight: fast, brutal, seemingly out of nowhere. The truth, however, is much less dramatic and far more uncomfortable. Silver did not crash in a day. It was being prepared for that fall for months. In the weeks leading up to the sell-off, silver had become a crowded trade, not just popular, but emotionally crowded. Every rally reinforced the same narrative: that silver was undervalued, that it was lagging gold, that industrial demand from solar panels, EVs, and green energy would push prices relentlessly higher. None of these arguments were fake. That's what made the situation dangerous. When a story is mostly true, people stop managing risk and start betting their identity on it. What quietly changed beneath the surface was positioning. Leverage kept rising. Futures exposure grew aggressive. Retail traders, hedge funds, even systematic funds leaned harder into the same direction. The market stopped being about price discovery and started becoming about belief. And belief is fragile. At the same time, the macro environment was shifting in a way most silver bulls did not want to acknowledge. The Federal Reserve's tone was hardening. Interest rate expectations were adjusting upward. The US dollar was slowly but decisively strengthening. These are not dramatic headline events, but markets do not move on drama. They move on pressure. And pressure was building. Silver, like gold, does not yield, it does not pay interest. When real rates rise and the dollar strengthens, holding metals becomes a psychological decision rather than a financial one. That doesn't mean prices must immediately fall. It means the margin for error disappears. The rally becomes fragile. Then came the trigger. Not a single catastrophic announcement, not a secret manipulation, not a shadowy conspiracy. Just confirmation of what the market had been avoiding, that monetary conditions would remain tighter for longer, and that liquidity would not come to the rescue anytime soon. The first technical levels broke. Algorithms reacted instantly. Stops were triggered. Margin calls followed. At that point, it no longer mattered why silver was falling. The market had shifted from reasoning to survival. Forced selling is not emotional, it is mechanical. Positions are liquidated not because traders change their minds, but because they no longer have a choice. This is the part retail investors rarely see. When liquidity disappears, prices don't move logically, they gap. Buyers step aside, not because they think silver is worthless, but because they know they can buy it cheaper later. In those moments, even strong assets fall as if they are broken. As silver collapsed, the shock waves spread. Cross-asset correlations tightened. Risk was being reduced everywhere. In the crypto markets, leverage positions tied to commodities and macro trades were unwound. Bitcoin and Ethereum saw liquidation spikes not because crypto fundamentals suddenly changed, but because capital was being pulled back across the board. This was a liquidity event, not a narrative shift. Social media reacted predictably. Accusations of manipulation, claims of paper markets suppressing real value, emotional certainty delivered with no evidence. This always happens after violent moves. Humans look for villains when they are unprepared for consequences. But markets don't need villains. Excess leverage is enough. What makes this crash particularly important is not its size, but its timing. It happened when confidence was high, volatility was low, and most participants believed downside risk was limited. That combination is always dangerous. Markets punish comfort more aggressively than fear. Now comes the question everyone asks too early. Will silver pump again? That question reveals more about psychology than about price. Markets do not owe anyone a rebound. They reset first. Confidence must be rebuilt. Positioning must normalize. Volatility must compress. If silver stabilizes, forms real support, and trades without emotional extremes, a recovery becomes possible. Not explosive, not euphoric, controlled. The fundamentals that supported silver before the crash did not disappear. Industrial demand still exists. Supply constraints still matter. But markets are not pricing machines. They are timing machines. Being right too early is indistinguishable from being wrong. The deeper lesson here is not about silver at all. It is about human behavior under certainty. When everyone agrees on the future becomes fragile. When leverage replaces patience, volatility replaces logic. This crash was not an accident. It was a reminder. Welcome to Monk Media YouTube channel. What most people underestimate after a crash like this is the psychological damage it leaves behind. Markets are not just charts and numbers. They are collective memory. Every sharp sell-off rewires behavior. Traders who were confident days earlier become hesitant. Dip buyers hesitate. Long-term investors demand proof instead of promises. And institutions, more than anyone else, slow down. Institutional money does not chase rebounds. It waits for silence. It waits for volatility to exhaust itself. It waits until headlines stop screaming and social media stops pretending certainty still exists. Only then does capital quietly re-enter. This is why rebounds feel boring at first. By the time they feel obvious, most of the move is already gone. In silver's case, the damage was amplified by how extended sentiment had become before the fall. Open interest was elevated. Futures positioning was aggressive. Even conservative funds had begun increasing exposure, convinced that macro conditions would eventually force metals higher. That kind of consensus rarely ends gently. Another factor that mattered deeply but received little public attention was timing relative to global liquidity cycles. Central banks outside the United States were not easing fast enough to offset the Fed's stance. Dollar liquidity was tightening at the margins. That may sound technical, but it directly affects how much risk the system can carry at any given moment. When liquidity contracts, leverage becomes toxic. Silver simply happened to be one of the most exposed pressure points. This is also where many comparisons with gold began to fail. Historically, silver is more volatile than gold, both on the upside and the downside. It behaves like a hybrid asset, part precious metal, part industrial commodity. In rising markets, that dual identity attracts capital. In falling markets, it scares it away. Gold can hide in fear, silver cannot. As prices fell, another quiet dynamic kicked in. Hedging flows. Industrial users who benefit from lower prices did not rush in immediately. They waited. Producers adjusted hedges. Refiners recalibrated inventories. None of these actions make headlines, but they influence how fast a market can stabilize, and stabilization is the prerequisite for recovery. Meanwhile, retail traders were experiencing something different entirely. Many of them were not just wrong, they were trapped. Liquidations erased accounts, forced exits locked in losses. This is why post-crash narratives become emotional. People do not argue about data, they argue about pain, and pain always demands explanation. This is where conspiracy theories thrive. It is easier to believe the market was manipulated than to accept that leverage magnifies mistakes. It is more comforting to blame institutions than to admit crowd behavior can be self-destructive. But the uncomfortable truth remains: the system behaved exactly as designed. What comes next depends less on price and more on behavior. If silver continues to trade with wide ranges, sharp intraday reversals, and emotional volume spikes, it is not ready. Those are signs of unresolved positioning. If instead volatility compresses, daily ranges shrink, and volume normalizes, the groundwork for a sustainable move begins to form. That process cannot be rushed. Macro conditions will continue to matter. If the dollar remains strong and real yields stay elevated, silver will struggle to regain momentum quickly, not collapse, but drift. Markets often punish impatience more than they punish incorrect analysis. However, if inflation data reaccelerates, if growth slows faster than expected, or if monetary policy expectations pivot again, silver could regain relevance as both an inflation hedge and an industrial asset. That shift would not start with headlines. It would start with positioning, quietly rebuilding. One of the biggest mistakes traders make after a crash is expecting symmetry. They expect the rebound to mirror the fall. That almost never happens. Crashes are fast because fear is immediate. Recoveries are slow because trust is earned. The market must prove stability before it can justify optimism. This is also where crypto comparisons become instructive. Crypto markets live in a permanent state of leverage. Liquidations are routine. What silver experienced was rare only because commodities usually move slower. But when leverage builds, the outcome looks the same everywhere. Different asset, same human behavior. From a long-term perspective, silver remains strategically important. Industrial electrification, renewable energy, and technological demand are not disappearing. But long-term value does not protect against short-term excess. Timing still matters, entry still matters, discipline always matters. The professionals watching this market now are not asking whether silver is cheap. They are asking whether silver is calm. Cheap assets can always get cheaper. Calm assets invite capital. In the months ahead, the narrative will shift again. It always does. Pessimism will peak, participation will drop, coverage will fade, and somewhere in that quiet period, the next real opportunity will begin forming. Unnoticed by most, dismissed by many. That is how markets reset. This crash was not a failure of silver's story. It was a failure of patience, a failure of restraint, and a reminder that markets move not on certainty, but on balance. Silver will trade again, trends will return, but the era of easy conviction is over, at least for now. As the market moves past the initial shock, attention slowly shifts from what happened to what must happen next. This is the most dangerous phase because it is where impatience quietly replaces analysis. Prices stop collapsing, and that alone convinces many that the worst is over. Sometimes they are right. Often they are early. After a liquidation-driven collapse, markets typically enter what professionals call a digestion phase. It is not dramatic. It does not reward emotion. Price action becomes frustrating. Rallies fade. Sell-offs stall. Volatility compresses and expands in short, uneven bursts. This is where weak hands finally leave and stronger hands begin their evaluation. For silver, this phase is unavoidable. The market must absorb the consequences of excess leverage. Contracts that were forced out do not immediately reappear. Capital that was burned does not rush back. Confidence once broken reforms slowly and only after repeated proof that stability is real. One of the clearest signals institutions watch during this period is time, not price. Time spent without making new lows matters more than quick rebounds. When an asset survives multiple macro headlines without collapsing further, it begins to earn credibility again. Silver has not reached that point yet, but the process has begun. Another element quietly reshaping the outlook is hedging behavior from industrial consumers. These participants do not speculate. They react to margins, costs, and operational certainty. Lower prices eventually encourage longer-term procurement, but only once volatility declines. No manufacturer locks in supply during chaos. Predictability matters more than discounts. On the macro side, the world remains caught between two conflicting forces. Inflation has proven stickier than policymakers hoped, while growth shows signs of fatigue. This tension creates uncertainty around interest rates, which in turn keeps pressure on all non-yielding assets. Silver sits directly in that crossfire. If monetary policy remains restrictive longer than expected, silver's recovery will be slow and uneven. If policy expectations soften even slightly, silver becomes highly sensitive to that shift. This asymmetry is important. Downside pressure builds gradually. Upside pressure, when triggered, can arrive suddenly. Yet this does not mean a straight line higher. The market remembers pain. Sellers who missed exits will use rallies to reduce exposure. This overhead supply caps early advances. Sustainable trends only begin once that supply is absorbed. That absorption process is quiet and often boring, which is exactly why most participants miss it. Retail traders, meanwhile, tend to re-enter too quickly. The memory of the prior high remains fresh. Loss aversion pushes people to chase break-even rather than opportunity. This emotional positioning creates resistance zones that are psychological, not technical. Markets respect these zones more than charts suggest. Media coverage also plays a role here. During the rally, silver was framed as inevitable. During the crash, it was framed as broken. Neither framing is accurate. Markets are rarely heroes or villains. They are systems responding to incentives. When incentives change, narratives follow, not the other way around. The more sophisticated investors understand this. They are not asking whether silver should be higher. They are asking when risk becomes underpriced again. That distinction defines professional thinking. Should is irrelevant. Is everything. A realistic forward path for silver includes extended consolidation, failed breakouts, and skepticism. That is not a bearish forecast, it is a healthy one. Strong trends are built on doubt, not confidence. Confidence comes later, usually after opportunity has passed. This is also where longer-term structural demand begins to matter again. Energy transition projects do not pause because markets crash. Technology adoption does not reverse because traders over-leveraged. But these forces operate on multi-year timelines, not quarterly charts. Markets must survive the short term before they can price the long term. In this sense, the silver crash serves as a filter. It removes speculative excess and forces the market back into alignment with reality. That reality is slower, more complex, and far less dramatic than social media suggests, but it is also more durable. Eventually, a new narrative will emerge. It always does. It will sound reasonable. It will be supported by data. And once again, the danger will not be the story itself, but how aggressively people act on it. The lesson for anyone watching is simple but uncomfortable. Markets reward restraint more often than conviction. They punish certainty more often than ignorance. And they rarely move on the timeline people expect. Silver is not finished, but it is also not in a hurry. The crash was not the end of a story. It was the end of an illusion. The illusion that outcomes are guaranteed when enough people agree. What comes next will be quieter, slower, and far more revealing. In the end, what matters most about the silver crash is not the number of dollars it fell, but the assumptions it exposed. Markets have a way of revealing truths when participants stop listening. This episode reminded everyone, from retail traders to large institutions, that price is not just a reflection of value, but of positioning, timing, and restraint. Silver did not fail because its long-term case disappeared. It failed because too many people treated a multi-year thesis like a short-term guarantee. They confused direction with timing. They mistook consensus for safety. And when conditions shifted, even slightly, the system corrected that imbalance with force. This is how financial markets maintain equilibrium. Not gently, not fairly, but efficiently. The crash stripped away the illusion that conviction alone protects capital. It demonstrated that leverage amplifies belief just as easily as it destroys it. And it reinforced a lesson markets teach repeatedly, but few internalize, that volatility is not an anomaly, it is a feature. As the dust settles, silver will remain where it has always been, at the intersection of industry, inflation, and psychology. It will respond to policy, to growth, to currency dynamics, and to human behavior. Sometimes it will lead, sometimes it will lag, but it will never move in a straight line simply because a narrative demands it. Those who approach the market now with patience, humility, and discipline will find opportunity when others are still debating blame. Those who rush back seeking redemption will likely repeat the same mistakes under a different headline. The future of silver will not be decided by a single data point or a dramatic announcement. It will be shaped gradually, quietly, as positioning normalizes and incentives realign. By the time certainty returns, the opportunity will already be priced in. That is the paradox of markets. Clarity arrives last. This moment, uncomfortable as it feels, is part of the cycle. Not an ending, but a transition from excess to balance, from confidence to caution, from noise to signal. Silver will move again, trends will form again, capital will return again, but not on command and not on schedule. The market has made one thing clear. It does not reward impatience and it does not forgive certainty. And that, more than any chart or headline, is the real story behind the silver crash.